Hello, everybody. So today I want to talk about STEM again because the stock has been trending down for a few days and it is now trading at its lowest valuation ever at $2.63 per share. And if you look, it's actually 20 times cheaper than at its peak right now. So it's 95% down. And obviously, the company is so much further ahead today than it was really 2 years ago. So a 20x difference between the top and the bottom. This is what you get when you invest in innovation and hyper-growth stocks. And when the time horizon of money, when the interest rates go up, these companies just get entirely hammered by the market. And if you care about stock price, I understand it can be painful and stressful. And this is a stock that I do not own anything meaningful, just a few shares. And as I said as in the last video, even though it's really, really down quite a bit, I can't justify buying STEM when Tesla and Enphase are trading at the level that they're trading. Right? Because STEM was always a tougher decision, a harder decision than a Tesla or an Enphase. And when you see how depressed the valuation is, for example, for Enphase, I have a hard time justifying buying a middle quality asset. I'm gonna call it when you can have a pristine asset like Tesla or Enphase at these prices. So that's why my new money right now mostly goes to Tesla and Enphase. But I am willing to consider STEM an option, and I think it is an option on what it could become, and I just want to say there's a lot of good things going for it. For example, according to Seeking Alpha, if you look, the forward growth analysts are predicting 85% forward growth per Seeking Alpha. So that's tremendous growth. Now let's keep in mind a bunch of that growth is installing these megapacks for businesses. So it's a lot of revenue, but very little margin. And analysts may be wrong. They may be sleeping on this stock. I've seen things on Twitter, people saying that the revenue growth may be as low as 30%. Well, 30% is still above my threshold, but obviously 85% is a much better rate of growth. If you look at the guidance, I do not understand why this stock is trading way down since they reported earnings. Very even more down, even though the guidance is up quite a bit. Revenue guidance is up, and adjusted EBITDA guidance is up, and recurring revenue guidance is up, and the bookings are doing better than ever. So again, the stock market is a voting machine in the short term. It's very hard to understand why the stock is so cheap. I can't explain it. I can tell you stock prices don't really bother me. And it's probably a better idea to just hide the stock prices on one's brokerage account. You just hide it. Many good brokerage firms have a toggle where you can just click and hide prices, and then sleep well at night, because these things are going to be volatile, right? I wouldn't be surprised if this is a stock that's going to be $10 in the near future or more, or it could go to $1.50 or $1.20. Right? I mean, keep in mind, I've owned stocks like Open Door, and I still own Open Door and believe in Open Door. So, and it's a stock that has been much more of a roller coaster than even STEM. But if you look at the numbers, frankly, they're okay. Obviously, the gross margin is the problem for this company. 17.5%, that's very low gross margin. Revenue has never really been a problem. If you look at the price right now, enterprise value over gross profits, that's a 9. So you're not the cheapest ever, right? It's not the cheapest ever. It's not like a StoneCo or a HIMS, but you're getting into definitely very cheap territories. Enterprise value is only 885 millions. Now, I'll get into the debt a second, but of course, don't be fooled by the market cap, because this is a company that has quite a bit of long-dated, long-maturing debt. Their debt matures in 2028. But let's not be fooled by market cap and actually use enterprise value for this company. The bulk of the valuation of this company, in my view, is in the recurring revenue of their software. That's where the money is at. And if you were to just value the recurring revenue at year-end 2023, we know it's 80% gross margin for them. So you do enterprise value over that gross profit in the recurring revenue, and you're getting at a 12x recurring revenue. If you were to compare it to a monitoring SaaS stock, because this is obviously monitoring of energy assets. Datadog is a monitoring stocks for data applications and the cloud, and it's trading at a 20x multiple. So I would argue the market is still giving a premium to STEM if you just value it on the software basis. It's still giving a little bit of a premium to STEM. But the software, over the long run, in my view, the software is going to be the bulk of the revenue for this company. I just wanted to say a few things about the debt. So we know they have $125 million in cash. And last video I said I don't think that's going to be a problem. I don't think they're going to have to do a capital raise. I may be wrong, but I don't think so, because they are becoming almost cash flow positive, right? EBITDA is a good proxy for cash flow, and in 2024 it's likely that they'll be free cash flow positive, in my view, in 2024. So I wouldn't be too worried. They may dig a bigger hole in the 125 million, but I don't think they'll run out. And we have the debt, $605 million in debt. But if you go to the conference call, the latest conference calls, this is the CFO talking to us. The CFO says, as a reminder, we do not have any direct interest rate exposure by virtue of our fixed rate debt, which has maturities into 2028 and 2030. So these are long dated maturities. In my view, interest rates in 2028 will be back to the way they are right now. So I don't consider, I'd like to see way less debt, but to me, this is not a deal breaker for this company, right? They have a lot of debt, but 2028 maturity is a blessing, if that makes some sense. No financial advice, but the rational explanation for me for the stock being so down is just that the market is extremely irrational. It's 26% short. I was looking at different sources, different websites. There's a website that looks at dark pools. I don't know if you've heard of dark pools. Anyways, I'm not very interested in short selling. It's not a topic that interests me. I think it's I think it's a flaw of the modern financial system, short selling. But I've seen as much as 45% in dark pools that STEM would be shorted. So the short probably has a lot of things to do with why this stock is at an all-time low. And does it make sense that it's an all-time low? Well, possibly, because if you look at the valuation of, say, a company like Tesla or Enphase, which are also in the energy revolution space, which are companies that I've followed for a very long time, for example, I could make a very strong case that Tesla Energy is worth $200 a share for the Tesla stock, right? And Tesla is trading at $220. So clearly the market is giving no value whatsoever to the energy storage business right now. And this may be further true as we see that oil prices are trending down, and oil is cheaper again. In my area, the prices in my area are $2.49 a gallon. So oil is cheap right now. Yeah, it's cheap again. So maybe that creates some of this bad sentiment about energy storage, electricity energy storage. Over the long run, doesn't matter to me. These prices are going to keep going down, and these systems are going to be always much better, in my view, in peaker plants, and they are necessary as we transition to a charging infrastructure. As electric trucks, for example, need ultra-fast charging, those 750 kilowatt chargers, they need these megapacks, such as those installed by STEM, such as those installed by Tesla and sold by Tesla. The market gives very little value to this space right now, and STEM is a pure play in the energy storage system space. The stock is also trading at the lowest ever from a price to sales ratio, right? We are at about 1x sales, which is pretty ridiculous, if you ask me, because this company is well within its own megatrend. So what am I doing with STEM, and what's the reminder of a thesis for STEM? So what are we getting with STEM? Well, in my view, I look at STEM as an option. And, I might add a little bit, but if I add shares, like let's say I add a few shares of STEM at whatever it's trading at, 250 or 270, I don't even know, 263, there you go. So trading at 263, to me, I look at this as an option, right? It's very similar to what you would pay in an option price. So to me, it's an option, but you get stock. And it's an option on a potential future of success for this company. It's obviously higher risk, but it's an option on Athena. Athena in my view, is the bulk of the appeal for this company. That's the competing software to Tesla Energy software, and they offer similar functionality. In the early days, when I was studying the stock, I did a face-off between Athena and Tesla Energy, and we can see that many of the functions that Tesla Energy has, for example, Athena has, like for example, Auto Bidder. You have Tesla Auto Bidder. Athena also has a power trading software. I think the software is the bulk of the value. You also get a low margin megapack installation and engineering business. This business is not very interesting to me, but this business is obviously necessary for STEM to be able to sell software. But just because I don't like this business very much doesn't mean the market is not going to like this business at least a little bit, and probably more than a 400 million and change, market cap. Probably more than that, in my view. This is a space. This is a company that's at the core of a megatrend. And pour STEM, the only thing you get is also energy, which is, in my view, a compelling software for solar and storage energy monitoring, large solar systems. And look at a company like Nextera. Right, Nextera is way down. Solar is not the space to be right now. The market hates solar. The market hates energy. The market hates small cap. So STEM is right in the middle of everything that the market hates. Right? The market hates debt. The market does not dig enough into the accounting matters of these companies. So that's just the way it is. The market is not voting for STEM right now, in my view. And I'll just conclude with this, talking to you a little bit about the gross margin. Just quickly talking about this. So, a lot of the financial media is showing a 1% gross margin, and that's because they report GAAP metrics. And if you dig a little deeper, you realize that STEM, and this could be a reason why the stock is so down too. STEM actually messed up a little bit in its gross margin, is that it put a guarantee in some contracts that they sold a few months back, and that guarantee was that the value of the hardware would remain similar. And I assume they had to put that for financing purposes. And as it turns out, the value of the hardware that they had sold had fluctuated, and they had to reduce revenue by $37 million. And that is why they ended up with minus 15% loss, because they had written the contracts wrong and they had to give back $37 million. But in the call, what do we see? The company does not intend to provide such guarantees and customer contracts going forward, and does not expect that the future revenue reduction, if any, will be material. So they don't expect that what happened to gross margin this quarter, which was due to poorly written contracts and they've made a mistake, they don't expect that to happen again. So again, STEM, stock that made a little mistake on its $37 million mistake. It's a medium mistake. But STEM, in my view, is a medium. I don't want to say a medium quality stock, but it's not the best in breed in the space, right? The best in breed in the space, in my view, is Tesla. But nonetheless, the market is unforgiving right now. So these are all of the reasons why I think the stock is down. I don't think it deserves to be down so much. If anything, this is a learning opportunity. How can a stock in a matter of 2 years and a half go from 20x more expensive to 20x cheaper right now? There's clearly some place where there's irrationality going on, and in my view, the forward, future-oriented stocks trading so down today because of the cost of the interest rate, I think that is the irrational behavior. I think the rational behavior was earlier, before we had these rate hikes, which are a bluff, in my view. These rate hikes are a bluff. The government is issuing more debt than ever, right? The BTFP program is issuing debt to regional banks covertly, right? And there will be no choice but to go back in a low interest environment. And this may be a stock which, if I buy a little more as an option, I believe may do very well. But anyways, if you're in this stock, I would just turn off the trading app, or delete the trading app. Of course, this is entertainment. This is not investment advice. This is just what I would do. Just what I would do. Not investment advice. I hope you were entertained. Please like the video if you can. Please subscribe if you can. Thanks for watching and have a wonderful day.